with the contraction we've had in the money supply, nominal GDP is slowing down, and I think the real component will slow and add to the picture the regime uncertainty, and we might even see a recession late this year. I wouldn't be surprised if we had a 15 or to 30% correction in the market.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Over recent years, today's expert's been consistently one of the best predictors of where the inflation rate's headed. So, where does he see it headed from here? And how about interest rates? And why is he calling the Federal Reserve, quote, an engine of income inequality? To find out, we've got the good fortune to sit down today and get a full update from Steve Hanke, professor of applied economics at the Johns Hopkins University in Baltimore, Maryland. Steve, thanks so much for joining us today.
Great to be with you again, Adam.
All right, Steve. Well, look, an awful lot has happened since the last time you and I talked. So I very much want to get your latest thoughts, your latest outlooks. I've been reading your very active X feed, but also, a lot of the other interviews you do out there in the world. Sounds like you've got a lot to say about what's going on right now. So let's dig into any and all of it. If we can, though, let's just start from a very high level. I'm going to ask the question I like to ask you when you first joined me here. What's your current assessment of the global economy and financial markets?
Negative.
All right, pretty easy. I like how you don't mince words. All right, a little exposition on that one. Why negative?
Okay, so first, let's start at home, and then we'll go around the block. In the United States, the thing that really drives the economy has an influence on real economic activity, as obviously, and also inflation, are changes in the money supply. And what we've had since about the summer of 2022, the Fed has thrown things in reverse, and we've had a contraction in the money supply, and the stock of money in the United States now, measured by M2, that's the broadest measure the Fed has, is actually lower than it was in June of 2022. That kind of contraction, Adam, has only happened 4 times since the Fed was founded in 1913. And all 4 times we had recessions that followed the money supply contraction. And actually, one of the 4 times was 1929, 1933. You know what happened then. We had a Great Depression. Of course, the money supply really contracted. It went down by about 38% in the Great Depression era. So a slowdown is pretty much baked in the cake, because the way it works, you get the change in the money supply, the slowdown in the money supply, and then it takes a while for it to transmit into the economy. And it's taken actually quite a while this time. I thought we'd be slowing down before now. The reason we didn't slow down quite as fast as we normally do is that after the pandemic, the Fed goosed the money supply so much that there was so much excess cash balances in the system that it took a while for that excess to burn off, and it did burn off late last summer, and now we're kind of running on fumes, shall we say. So that's the background of the United States. In addition to that, of course, we've got a new administration in which there are a lot of changes being made, and something called regime uncertainty, I think, is setting in. And what I mean by that is that all the rules of the game are kind of changing, and people become very uncertain about their private property rights and the rights that they have. They might own the title to something, but the question is, well, what's the free cash flow going to be from that, whatever it happens to be? So we have this regime uncertainty, which it's different than uncertainty. Uncertainty is kind of spotty, you know, this thing and that thing could happen. But regime uncertainty basically means, you know, you're upsetting the apple cart, changing everything. The best example of regime change uncertainty in the United States was the New Deal with Franklin Delano Roosevelt. Now, remember the propaganda about the New Deal was happy days are here again.
Mm-hmm.
Well, it wasn't so great. There was a lot of regime uncertainty. There was nationalization of property, changes, big changes in the tax code, changes in union rights, et cetera, et cetera, et cetera. Many things were changing. Many new bureaus and agencies were set up, and the expansion of the U.S. government was quite large. The grabbing hand of the U.S. government became a lot more significant. And for example, just on the monetary part of the thing, the gold clause was abrogated, and the gold that happened in January of 1934. Now, what the gold clause said is that any bonds, any dollar-denominated bonds that had been issued under the gold clause gave the owner the right to principal and interest being paid in dollars or gold, and gold at the rate at the time of the issuance of the bonds. Well, all of that changed when they abrogated the gold clause in 1934, and the dollar became 41% lighter than it was before. So that's part of regime uncertainty. The whole monetary scheme was being changed. We had nationalization, we had tax the rich, we had union power, we had this monetary change, all in the name of a national emergency. We have a national emergency, the Great Depression. Happy days are going to be here again. We have to make all these changes. Well, what happened is that investors became very uncertain about the veracity of their private property rights, and as a result, they hunkered down and they stopped investing. So from 1929 until actually after World War II, there was almost no investment in the United States. And what the regime uncertainty did, in a nutshell, it elongated the Great Depression. It made the Great Depression last much longer than it would have if we hadn't had all these regime changes. So that's what we have with the current Trump administration. And you know, you go down, you mentioned tariffs. Well, yeah, tariffs are actually one thing, but you've got the rule of law with retribution coming in, international relations. Well, we basically got everybody in the world mad at us, with the exception of a few countries. And President Trump, he wears two sets of clothes. On Ukraine, he's the president of peace. He wants peace in Ukraine. In the Middle East, and including obviously Iran as the main target, he wants war. And then we've got Elon Musk and Doge in there, restructuring the government. And we also have something going on, a lot of ex post facto laws coming in, because, for example, universities have research grants. They've taken a lot of those away or stopped payment on them. Well, that's breaking. They're breaking contracts. A research grant, it's just not a gift they're giving the university. The university has a contract to do research, and they wouldn't have to renew those, but to just stop them in mid-track, that's ex post facto law. That's you find that in developing countries. So this is all regime change and regime change uncertainty, and that comes into play because if the economy is slowing down because of the monetary contraction and might go into a technical recession this year, Add to that regime uncertainty, and you got a real problem on your hands. So U.S. is negative. Forget the "Make America Great Again" mantra. It's very doubtful if that's going to happen with all these policies. For example, you take tariffs just as one. Tariffs are a complete disaster. They're not going to make America great again. They're not going to change the trade deficit that the U.S. has. So that's the U.S. Now let's go to Europe. Europe's even worse. Europe's been in a complete slump since the great financial crisis in 2008. And now Europe, they want to go to war with Russia. They're becoming more militaristic. And if you look at the budget, and the UK, for example, it just came out yesterday, the Chancellor of the Exchequer, Reeves, wants to increase military spending and reduce welfare spending. Well, I don't have any problem with reducing welfare spending, but you're increasing military spending. You think that's going to be very popular in Great Britain? So you're just asking for trouble there. And by the way, Europe's gross national product since the great financial crisis in 2008, it's been flatlined. It hasn't done anything. The U.S., in comparison, since 2008, the gross national product in inflation adjusted terms, it's gone up about 25%. Europe is nothing has happened. So that's Europe. It's going no place. It's going to continue to flatline. Now we go to China, which of course is a huge economy. Depending on how you measure it, it's either the second largest or the largest economy in the world. And they have a lot of problems. They've had this housing crisis. They were over leveraged. Now they're deleveraging. So they kind of have a balance sheet slowdown, shall we say. In addition to that, the money supply is growing at an anemic rate. It's too slow. The growth rate in the money supply in China is 7%. Hanke's golden growth rate for the money supply growth measured in M3 in China is 10%. And that's a rate consistent with hitting China's new inflation target of 2%. So they're in a balance sheet sort of recession where they're deleveraging, and the money supply is not growing up to the point where it should grow, and as a result, they're actually in more or less a deflation. I mean, there's no inflation in China, so China's in big trouble. So that's kind of the summary of the big 3 points.
All right, so there's really there's no one really to ride to the rescue here in terms of the global economy, is what I hear you saying. Sort of like in 2008, kind of China helped pull a lot of the world out of its malaise by levering up, spending a lot, growing its economy a bunch. They can't do that this time around. EU is stuck in the mud, as you're saying, and US, you think, is its outlook does not look great for reasons of both a slowing economy because of slowing monetary supply and all this regime uncertainty that you talked about. So yeah, other than that, Mrs. Lincoln, how do you enjoy the play, basically, right?
Yeah, well, exactly. So I think, do we want to stop here or go ahead?
Yeah. Well, no, so let's actually not. Let's lean in. So in our previous discussion, Steve, mentioned in the intro that you've been one of the best or most accurate predictors of where the inflation rate was headed, and you have relied heavily in that outlook on the formula for the quantity theory of money. One factor of which is money supply, which is, at least in the U.S., you said the Fed's thrown it into reverse. So does that mean you sort of expect from an inflation perspective that the Fed will succeed, that it will get inflation down to its target, and who knows, maybe it might even go a little bit lower.
Well, yes, I think this year we'll probably see the headline CPI number come in at 2%. That's the Fed's target. It might even we might even get a few months where it's actually below that. But remember, the key to this is how to think about it. The reason for this is what was happening with the money supply a couple of years ago. Not what's happening today. So there's always a lag, Adam, between changes in the money supply,
sure,
changes in asset prices, changes in real economic activity, and changes in inflation. And most people are just watching the day-to-day data. They have no theory of national income determination. My theory that I'm articulating with you is the quantity theory of money. And most people don't understand the quantity theory of money. Even the Fed, the central bank, poo-poos it and indicate that, as Chairman Powell likes to say, we know of no reliable connection between changes in the money supply and changes in economic activity. So when we talk about a model for national income determination, well, what is a national income determination? That's nominal GDP. We're trying to look out ahead and get some idea of where nominal GDP is going. Now, nominal GDP has two components. One is the real rate of growth in the economy, and then you have to add to that the inflation rate in the economy. If you add those two growth rates together, you get nominal GDP. And that's what the quantity theory of money tells you, or helps to allow you to understand. And with the contraction we've had in the money supply, nominal GDP is slowing down. And I think the real component will slow and add to the picture, the regime uncertainty, and we might even see a recession late this year. And I think inflation, which is 2.9%, John Greenwood and I said at the end of last year, we had a forecast. We said it would be between 2.5% and 3%. Well, it was 2.9. That was pretty good. So we did get that right. The one thing that I will say is that using the quantity theory of money, there've been, in this up and down cycle, there have been four things that we've been trying to get our head around and forecast. And that is, on the upside, what was going to happen to inflation and what was going to happen to real economic growth. Greenwood and I nailed that. We said inflation would go up to 9%. It went up to 9.1%. And we said we'd have a strong real economic activity. We did. Then on the downside, we got the inflation part right, but we anticipated we'd be slowing down even last year. Well, we didn't. So we got that wrong. And the reason we got the thing wrong was, so we got 3 out of 4.
That's pretty good.
It's pretty good. No one comes close to that record. What they like to do is point out, they say, oh, Hanke, you said we were going to have a recession in 2024. We didn't. You don't know what you're doing. Your monetary theory and the quantity theory of money is rubbish. No, it isn't rubbish. We've been much more accurate than anyone else. You put anyone forecasting against Greenwood and me in this up and down cycle we've had, and they can't beat us. So that's the story. But just to clarify, we didn't get it right because there was such an excess of cash balances that had built up and was overhanging the system and allowed people to keep spending. And that allowed the economy to keep booming along and not slowing down as fast as we would have normally expected it to.
Right. And of course, those cash balances were now paying a decent return, right, that they hadn't been paying in prior years. Let me ask you this too, Steve. I'm just curious, even though the Fed was quote unquote tightening, um, uh, it was also still pushing liquidity in the system through things like the draining of the reverse repo facility. So did that also help to kind of delay the arrival of the recession you initially thought might happen?
I don't think so, really.
Okay.
I think just uh, the key thing is look at the inverse of velocity, and it's the money supply over nominal GDP, and that's what went way up above trend, and that's where the inventory of the excess. It was m the inverse of velocity, the money supply over nominal GDP. If you had a trend line, usually the thing just goes up at about 2% per year. The money supply over nominal GDP. It wiggles around, but it's pretty much a linear line. So the linear line, all of a sudden, with a huge increase in the money supply that started in February of 2020, the thing jumped way up above the trend. And it came down and crossed the trend line late last summer, and now actually is a little below the trend, but it'll come up and it'll start wiggling around the trend again, unless the Fed does some another stupidity, which of course they might do.
All right. Well, let's get just to the rubber meets the road then. So, you said that there could be a recession later this year. How big of a slowdown are you expecting, as the past catches up to the formula?
I don't have anything in terms of the magnitude in mind. Remember, I come from a trading background, and if it's as a trader and someone who's had some pretty good trades. In 1995, I was president of Toronto Trust Argentina in Buenos Aires. It was the world's best performing emerging market mutual fund, #1 in the world. So I've been there, done that, and my sense as a trader is always I want to look at the direction of things. The magnitude I'm not so interested in. I'll worry about that later.
Okay.
But if you know what I mean. So somebody asked me, I happen to be a bull on gold, and I have been for a long time. So somebody says, "Oh, where's it going, Hanke? Where's your target?" I have no target. It's just in a bull market. I'm long, and it's going up. I mean,
Right. So,
I'm just
the first thing is to get the upright, and then how far up that comes secondary.
And the trick is when I say get the direction right, that means to get the turning point right too, because that'll be the change in the direction. You see what I mean?
Sure.
So
I do. I do. Okay, so I want to ask you about gold, but I'm going to hold that off to finish the recession part. So right now, it sounds like you're saying directionally slowing economic growth. Is that if we don't know severity, do you have a sense on duration? Like, is this something you expect to continue through 2026? So it will be multi-year, multi-quarter, or just a kind of a brief, hey, we had a little bit of bad weather?
It's kind of related to the question about how deep will it go. It's something I think it's just foolish to talk about either depth or duration right now. I mean, by the way, if it was 1929 and the money supply was contracting by 38%, I'd say we're going to have a hell of a depression and it's going to last a long time. We don't have that kind of thing. Right now, we have the stock of money being lower than it was in the summer of 2022, Adam, but the growth rate in the money supply, it's anemic. It's 3.9%. It should be, to hit the Fed's inflation target of 2%, should be about 6%. So that's the context for the whole thing. We've had the stock come down, very unusual, only 4 times in history since the Fed was founded in 1913, and we've had this anemic growth. It still isn't growing at 6%. So that's the backdrop to the thing, and the money supply is growing, but not very fast.
No, okay. So let me reword my question, because what I'm trying to do is get to make it relatable to the average person. So if you own a business, if you work for a paycheck, should you be, should you have a healthy concern going forward of just potential tough times ahead? So maybe you might want to take some action today about, coming up with a
Yeah.
plan B in case you lose your job, that type of stuff.
Yes. Yes. Now let me. So the answer to your rendition or scenario is yes.
Okay.
You want to be pretty careful. Point number one. Now, let me put this into context with the stock market, for example. Right now, the consensus for profit growth in the stocks is about 25% of profit growth. It's a very big number. I think with the slowdown coming and so forth, I think we'll probably see 5%. So that's how you think. If you had a business and you were thinking, oh, I'm projecting, the profits are going to go up 25% this year, and all of a sudden Hanke comes in and says, oh, they're not going to be they're not going to be 15%. They're not going to be 15%. They're going to be 5%. What would you do? You'd be a little careful.
Mm-hmm.
If that is, if you believed Hanke. Maybe if you didn't even believe me, maybe you'd start scratching your head and say, God, I don't know if the guy's right, but maybe there's something to what he's talking about. Maybe I'm going to dial back to 7.5% growth rate instead of 15.
Mm-hmm.
And what you do if you're running a store, you don't load up on inventory. You keep it thinned down, that kind of stuff.
Right. If you were planning on buying that, jet ski or something this year, stretching a little bit, maybe you push that off for a year just to make sure things go okay.
Yeah, you got it.
Okay. All right. Well, look, you're something that I've been saying I've wanted to do for a long time is I years ago wrote a guide I called it the Layoff Survival Guide, but basically it's a bunch of things that you should, if you get a pink slip, there's a bunch of things that you should do right away. And also, if you're worried about losing your job, but you haven't lost it yet, then there's a bunch of things you can do before hopefully ever getting laid off that can improve your odds or your prospects if you do happen to get that pink slip. So I'm going to get that thing re-updated and I'm going to put it on my website. So folks, if you want to read that, just go to thoughtfulmoney.com/layoff and you can read that Layoff Survival Guide. It's totally free. All right. So thanks. Thanks for both giving us your clear side on what you think is going to happen and really giving me that nudge I needed to get that darn thing done and out there for people. Okay, so
well, I like the title of thoughtful because I find that a lot of people they just don't think. Even at 30,000 feet, if you're going to think a storm is coming, what do you usually do? You make certain you put an umbrella in the damn car before you leave home. That's what thinking. You have to anticipate what's coming, and prepare for it. So don't panic. Think.
I look from a guy with a company called Thoughtful Money. You're preaching to the choir here. And as they always say, Steve, right? The best time to put a new roof on the house is when the sun is shining, right? Not when it's raining.
Remember Hanke's 5 Ps. I try to teach my students is prior preparation prevents poor performance. That's the 5 Ps. Now the one who transmitted that message to me was Jim Baker when he was President Reagan's chief of staff.
Mm-hmm.
And
really, you actually knew him?
Oh yeah, I was on. I served on Reagan's Council of Economic Advisors, and Baker.
I think I'd forgotten that, Steve. Thanks for reminding me.
Yeah, Baker was the chief of staff. So Baker, always say, Hanke, remember the 5 Ps. I said, what the hell's that? prior preparation prevents poor performance.
I love that, and I also love, and I'm forgetting exactly what you call it, but essentially it's kind of like a Hanke's law, which is like law of the universe or whatever, which is it's just one damn thing after another, meaning life would just keep throwing curveballs at you.
Yeah, absolutely.
All right. Well, look, I want to get to gold and I want to get to your market outlook real quick. I did mention in the intro that you have recently been pretty vocal with your displeasure with Fed policy, past, present, and past, and you have, gotten angry enough to say that the Fed is, quote, an engine of income inequality. And I couldn't agree with you more on this, but can you elaborate for folks why you're
Yeah. So,
you're
well,
throwing that against the Fed
when
now?
my back up in the general number one, I'm not angry at the Fed or anyone at the Fed. I mean, it's nothing personal, but I am a critic, and it's very important, I think, and I try to get this message across to my students. You can't use, if you're criticizing something, you can't use ad hominem. You can't criticize somebody personally. Never get involved with a personal kind of backstabbing and that kind of thing, or bad mouthing. It's just not the way to go. You got to get on the substance of what's going on. And my problem with the Fed is that the Fed, if they have a model for anything, it's not the right model. And the only model that's relevant for money in the Fed, central banks, is the quantity theory of money.
Mm-hmm. Which you say they sort of dismiss.
They've totally dismissed it. So they don't have that model, I can tell you, and that's the only reliable model. What model they have are a lot of post-Keynesian models, actually, and those models don't actually include an aggregate for money and the money supply. So can you imagine a central bank that has a model of the economy that doesn't include money?
Yeah.
That's what they're responsible for producing. The product they're supposed to produce is money. And that's why, by the way, they came up with all these ad hoc reasons for why we had such an inflation we had in 2021. Remember, it was the supply chain glitches, and it was temporary and
transitory, yeah,
and all of this stuff. So they were never able to predict anything because they didn't have the right model for anything. Greenwood and I, using the quantity theory of money, we did have the right model, and we predicted exactly what was going to be happening. So that's the main problem with the Fed is the whatever model they're using is not appropriate. It's not the quantity theory of money. So now you asked.
So that's the causal sin. So what's the pernicious effect?
Okay, here's the effect. You asked about the income inequality. How does it work? We know that with big changes in the money supply, the next thing that happens with a lag of around 6 to 9 months, asset prices change. And what happened? They goosed the money supply in February of 2020, and asset prices zoomed. The stock market went way up, real estate prices went up, land values went up, all the big asset categories all went way up. Now, who owns assets?
Right, the already wealthy.
Yeah, rich people own assets. So the rich made out like bandits. The lower income strata, they don't own any assets. If you look at their balance sheets, most of them are actually in debt.
Yep.
They're negative.
So you get the worst of both worlds. You don't get the asset boost, and you get all the cost of living increase. Yeah.
Yeah, you got it. So what happened is that if you look at right prior to the goose and the money supply, billionaires in the United States, U.S. billionaires, their wealth as a percent of GDP was 14.1% of GDP. Now what is it? It's 21.1%. The billionaires made out like bandits because of the Fed.
So I so appreciate you talking about this, because I talk about, I try to raise this a lot on this program. And, some people think, hey, it's all part of the grand plan of the small groups of people that, run the world, trying to become, trying to eventually own everything. I'm not entirely sure that that's the case. To me, I think it's just in a system over time, advantage concentrates somewhere, and then the people to whom that advantage concentrates, they then reinvest that advantage to their continued advantage, and things just kind of snowball. But I think you can say, look, whether we can argue the policy decisions over the past couple of decades in the moment were the right calls or not, can't deny that over the long run, the people that have benefited from them have been the already wealthy, and the downside has been burdened. The burden of that has been overly taken by the bottom, what, 90%?
Yeah, there are a couple of points on this. One is that the idea that there's some fixed group, and there's some conspiracy or something. It's basically nonsense. There's a huge amount of churn in the economy over the generations. A lot of people who are down at the bottom, they have children, and those children actually go way up, and a lot of them who are way up go way down.
Mm-hmm.
So that this is called the churn.
Right.
And in a free
the
market,
shirt sleeves in 3 generations, right? Yeah.
Right. So the point here is that this is the beauty of a free market economy. This is a result of a free market economy, the churn.
Mm-hmm.
If you don't have a free market economy, things tend to be pretty static, and there's no churn. So that's one point. Just a point of clarification. The other point that I'd like to make is that the Fed, and this, Matt Sakurki and I have a new book coming out. Wiley's going to release it April 29th, called "Making Money Work." You might put that thing up on your website. And
I will.
One of our big things is that the Fed, in terms of their policies, they should be focusing on neutrality, trying to make monetary policy as neutral as possible. So that we don't have these big biases coming in. It's not neutral now. I just gave you a perfect example of non-neutrality.
Right. And also, too, I mean, you said in a free capital market we get this churn and whatnot, but it's the interventions that basically make the playing field not as level, right?
But and this gets into something, of course, that I'm opposed to, and that's crony capitalism.
Mm-hmm.
The insiders that can lobby, the friends of the president and that kind of thing, and every president has friends, and the last two, by the way, have been it's pretty blatant what's going on.
Pretty blatant, yeah. And a lot of Congress people have friends too.
Oh yeah, they all have friends. Why do you think the members of Congress do so well in the stock market?
Right.
They do a hell of a lot better than the viewers of your program, I'll tell you that.
Oh, it's ridiculous. Yeah. And I'm sure you've seen the same, like Unusual Whales and the people that track the performance of these politicians, and they beat out some of the best hedge fund managers.
Yeah, exactly.
All right. So I guess the parting question on this, which we could make a whole interview over, but just, Steve, if we granted you, supreme authority, what would you do here in terms of reform?
Reform of what? The Fed, or just
yeah, it is this sort of grand topic, I guess, of inequality.
Okay.
Yeah.
So the Fed embrace and learn the quantity theory of money, and try to keep the broad money growth in the United States around 5 or 6%. Instead of that, would get us off this roller coaster thing, up,
Okay.
down, up, down. So that's the Fed.
So that would become the new mandate of the Fed, kind of?
Yeah, yeah, right. It would. So that's very important, by the way. And the full new mandate of the whole thing is laid out in Cikurki and Hanke's new book, Making Money Work. That's the whole point of the book, is to make the whole financial system work better. And part of that book, it's not just the Fed. Remember, most money produced in the United States is produced privately by commercial banks. And commercial banks from 1945 until the Great Recession, their assets were growing at about 7 to 8% per year. Since the great financial crisis, they've shrunk way down. They're only growing at 4.4%. We want to get them back at the center of things. Now, why have they been squeezed out? Well, remember the great financial crisis, the boogeyman, it was the banks and bankers, and you had Dodd-Frank come in with all kinds of strangling regulations on banks, stupid regulations on banks, and that was one thing. And also at about the same time, as Dodd-Frank, you had Basel III come in, which increased the capital asset ratios of banks. That squeezed them down. And then you had Fannie and Freddie, the government-sponsored agencies now. They were nationalized in 2008. And that's created a little bit of a sucking sound on deposit-taking banks. So we've got to get banks back at the center of things. That's part of the quantity theory of money. So money. And that, how do you do that? It's bank regulations are a big part of monetary policy. Most people don't think that. They think the meetings of the Federal Open Market Committee are the one and only thing that determines monetary policy. It's nonsense. Bank regulations, they don't change very often, they change slowly, have a huge impact on the growth and stability of the money supply because of what? Commercial banks. 75%, actually 76% of the money supply measured by M2 has been produced by commercial banks, not the Fed.
Right. And that's because they do the majority of the lending, or historically done the majority of the lending, and that's how new money is created. Yeah.
A bank loans Adam or Steve some money. What does that do? It goes into Adam's checking account or Steve's checking account. Checking accounts are counted as part of the money supply, M2. And it's fiat money. It's created out of thin air.
Right.
But it's underwritten by commercial banks that they're making the loan to you because they think you're going to put that money to productive use, and there'll be some surplus generated out of it. And oh, by the way, your factory where you're going to be producing that surplus will be collateral for the loan. So the banks have a direct link to the real economy. They're not only producing money, but they're linked up to the real economy.
So, getting them to loan more, be even linked more, will lead to more economic growth, get you to your golden 5% or whatever.
Absolutely. So on the monetary side, Cikurki and Hanke lay out the changes in bank regulation that would be appropriate to get to the golden growth rate and a steady rate of growth in the economy. And then the Fed, they can learn a lot by embracing the quantity theory of money and paying attention to the growth rate in the money supply. The other reforms, I just go back to Reaganomics. You want to deregulate the economy as much as you can. And I would also reform taxes. Forget the tariffs, get rid of tariffs, free trade, tax, a flat tax. No exemptions or anything. Everybody pays 15%. That's it. You send in a postcard every year. That's how you file taxes.
You know, I'm going through the tax um, process right now, and last night had a half-written tweet of my total frustration with how complicated taxes are. I've got a relatively simple situation. I'm still paying thousands of dollars every year on tax preparation and bookkeeping, and it just takes forever to get everything put together. And you still have no clue, even if you send in your taxes, that a professional is prepared, that the government's just not going to send you a letter saying, well, we think you owed a little bit more and we're taking it from you. It's just such an arcane, crazy process. So I'm a big fan of what you're proposing. And actually, we had Art Laffer on the program last week, made a very impassioned plea for just about everything you mentioned. He's not a fan of the tariffs. He's a big fan of deregulation. He's a big fan of less taxes, but certainly a flat tax. He's one of the biggest proponents of flat taxes. So, anyways, I think you get a lot of people watching this video who are probably saying, "Man, I wish I could live in Steve Hanke's world."
Yeah. By the way, speaking of Art Laffer, fortunately, Art's going to be making a public lecture at Johns Hopkins University on, of all days, April 1st. I'm going to introduce Art at 6:45, and he'll go. I hope the university's wise enough to have the thing on some kind of podcast or video. But
I hope so too. Is it open to the public or?
yes, yeah, it's a public lecture.
All right. Well, all right. So anyways, folks, if you live near Johns Hopkins, that would be a wonderful event to go to and catch both Steve and Art in person. All right, Steve, I got to speak quickly here just because we're running out of time and I got several topics I still want to get your thoughts on. Gold. So you said that you've been, an advocate of owning gold for a good long while, and that's true. Ever since I've known you, you've been a proponent of it. The day we're talking, gold is hitting another all-time high, at least in the futures market, but I think it might have hit a spot record today as well. Day's still young, so we'll see. Silver futures are over $35 an ounce for the first time in like 12 years or whatever. So clearly gold, the precious metals are continuing to have a moment. Given everything you just mentioned, do you think the metals have a tailwind to go substantially high or materially higher from here this year? Or again, you don't really care. You just think up is where it's going, and you're going to hold it.
The bull market is in gear, and some people ask me, well, is it a young or an old market? I don't know. It's just going up, and by the way, the regime uncertainty is playing a big part in this now.
Mm-hmm.
That's the new element. These new highs that we're reaching, the regime uncertainty, because President Trump, he announces a tariff one day, then he takes it off the next day, then he adds another one. It made the all-time high thanks to Trump yesterday, saying he was going to put a 25% tariff on foreign automobiles that were imported into America.
Right. So I guess, does that give you any concern that, let's say, like a year from now, the curveballs aren't coming as fast and furious as they are right now in the administration's early days? We kind of have more predictability of how the new administration is going to operate versus the rest of the world and the U.S. economy. Could there be a notable cooling off period in gold because the regime uncertainty, the regime is becoming more certain?
Not necessarily, because the underlying factor for the current bull market has been purchases of gold by central banks. So, and as many enemies as the United States is making now, and the way the United States has weaponized the financial system with sanctions, that isn't going away. So that's why the foreign central banks are buying. China is buying big time. Russia is buying big time. Private Chinese have been buying too. That's been a factor. I don't see any of that the underlying fundamentals. I don't think are going to go away, even if the regime uncertainty aspect cools off. But the regime uncertainty, by the way, might not cool off. That hypothesis might not be correct.
Might not come to pass, right?
Yeah, with the New Deal and Roosevelt, it just kept going on and on and on. I mean, and you get this, by the way. You can see this because remember that CEOs who just have their finger in their wind, they're not thinking about any of this geopolitical stuff. Remember when Trump came in, all of a sudden they became buddy. Everyone got on board. Now they're becoming scared. They're backing away. So
right, largely due to the regime uncertainty, but yes.
Right. That's my point. And that's what happened with the new dealers.
Right. And as you said, they just, investors entrenched for a very prolonged period of time. Okay, so it sounds then to the person who's watching who's saying, I'm kicking myself for not kind of getting on the gold train earlier, but man, it's moved so much now. Have I sort of missed the run? I don't get the sense you would say, yeah, you have. I think you would say, no, it's get on. We don't know how much longer it's going to go on, but the prospects look good.
You want to get on, but the question is when, and the best way to do that there is the Hanke Kaufman's Gold Sentiment Score. You've got to.
I was going to ask you about that. So how's that doing?
It does very well, and what we do. We text mine every article that comes out on the internet every hour and determine whether the article's bullish or bearish. And so the thing moves around every hour. The score moves around, and if it becomes very bullish, what that means is that it will eventually revert back to neutral or bearish, swing the other way, reverts, swings back and forth. So you want to wait till a thing is very bullish and anticipate that the market will correct and come down, and then you can buy.
All right. So you more or less kind of want to buy when it's extremely bearish, knowing that it will mean revert the other way at some point.
You want to buy when you're getting an extreme bearish reading.
Right. Okay, great. So folks,
it'll become bullish.
Right. You'll ride the bullish mean reversion.
So that's a timing thing, a 24-hour, 48-hour kind of a short-term thing. If you subscribe to the Hanke Kaufman's Gold Sentiment Score, you can kind of study the thing out, you get a better idea. I'm giving you kind of a simplified thing, but so if you really you can get your timing down with the Hanke Kaufman's Gold Sentiment Score. So you might put up our website. We just actually have a new website.
Okay, so what is the URL?
You would ask me something like that. Off the top of my head, I can't remember.
All right, you know what? You'll send it to me afterwards when we get it.
I'll send you a note, and you can put it up.
Great. And folks, I'll have it in the description below the video, and if it's a short enough URL, I will put it on the screen here, Steve. Okay. Also, folks, too, just FYI. Oh, sorry, go ahead, Steve.
Yeah, I was going to say I could come pretty close, but I might get it off just a little bit, and then people would be screwed up, and they wouldn't be able to get into the thing. You know how these things work. I mean, if you type in one letter the wrong way, you can't find anything.
Right. All right. Well, we'll get the right URL, folks. And again, it'll be at a minimum in the description below the video. Also, too, again, just for those folks that have not gotten, on the gold train yet and maybe still aren't fully sure of the different options and when it makes sense to buy, physical bullion versus some of the ETFs versus, if they buy physical, do you store it locally? Do you have it stored remotely for you? All that stuff. I have the new free gold buying guide that I put out a couple weeks ago. If you haven't yet read that, you can read it for free at thoughtfulmoney.com/gold. All right, Steve. Well, look, as we're in the home stretch here, as you mentioned, you were a trader. So in addition to asking you about the economy, I also like to just get a general sense of where you think the markets are headed, given this whole macro environment that you've described for us. As you look ahead for the rest of the year, I'm assuming with greater uncertainty and a slowing economy, you're probably not that sanguine on financial assets going forward from here, are you?
No, I remember also the slowing economy and slowing profits. The rate of growth in profits coming down will be much slower than the consensus. So I think Buffett more or less has things right. He's got Berkshire 27% cash. and he's liquidated all these long market ETFs. He didn't have much, but he got rid of them. And I think the market's overvalued, overpriced, and overhyped. And I wouldn't be surprised if and Hanke's Dr. X's bubble detector is in bubble territory. So I think we're probably in for. I wouldn't be surprised if we had a 15 or to 30% correction in the market.
Okay. So basically, more or less, a year to play it safe, a year to be like Buffett, raise some cash, have some dry capital, and then maybe be positioned to deploy that smartly if indeed we do get something like a 15 to 30%
Yes.
correction.
Yeah. Again, don't hit the panic button when you're listening to me talk. You want to think things through, like Buffett does.
Right.
And adjust things.
Use the 5 Ps.
Use the 5 Ps.
All right. All right. Well, look, Steve, I could go on with you forever, but we're coming up at the end of our time here. Couple of things. I want to ask how folks can follow you in your work. You have a number of different ways people can do that. So first off, you've got the new book coming out. What's the title of the new book, and where can folks pre-order it?
Okay. Well, you can. The book. My co-author is Matt Sakurki, one of my former students, who's a very polished guy and quite knowledgeable. And the book's titled "Making Money Work: Wiley as a Publisher." You can pre-order it on Amazon or maybe other places, but I know Amazon.
All right, but everywhere most books are sold.
Right, and another new one that's not only about 4 months old that you can get. I co-authored with Leland Yeager that's also relevant, and it's called Capital Interest and Waiting. Palgrave put that out. You might put that up on your site too. That's available all over the place. I mean, anybody selling books online is selling that book.
Okay. So in addition to your books, and in addition to checking out the Hanke Confidence Gold Index that you talked about, or Gold Sentiment Index, if folks just want to follow you and your general observations about things as time goes on, where should they go? Should it be your X account?
Yeah, the X account. I would suggest that's probably the best thing. That X account is at Steve_Hanke, and right now we're running 795,000 followers.
Wow. Jeez.
So apparently there's some satisfied customers that follow the thing.
There must be. I feel pretty good about my 95,000 followers, but man, you got 700,000 more than me, Steve. So
it's the third highest of any economist in the world, according to Focus Economics, and Barcelona tracks these things.
Okay, so to the extent there's a economist rock star, we're talking to him right now. So most of the people that watch this channel are just regular people, right? They're just trying to figure out how to make it through the day, build financial resilience and prosperity for them and their families. And they just don't want to get wiped out either by, some of this uncertainty that you've talked about, or just the Fed's, inequality engine grinding them down. What parting bits of advice would you have for that type of person?
Well, the one thing I was going to say, I guess it's general advice. If somebody wants to receive my weekly distribution of articles, podcasts, and things like that I've been on, just send me an email at Hanke, Hanke, at jhu.edu.
That's very brave of you to put your email out there.
It's public anyway.
All right. Well, look, thanks so much, Steve. Always wonderful talking to you.
Great
forward to having you back on in Q2. All right. Well, now's the time of the program where we bring in the partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money, to let us know what the markets have been up to in the past week since they've been on the program, and they've been up to a lot this past week. Joined as usual by Mike Preston and John Loder. Gentlemen, thanks so much for joining with me. Mike, why don't we start with you? So it's definitely been a very volatile week in the markets here. And there's been a fair amount of talk of late of, hey, the market's got so oversold, they're due for some sort of short-term bounce here. It looked like we were seeing that on Friday, that a week ago. The market was down and then managed to close green right at the last couple of minutes of trading. Markets then opened big on Monday. Monday had a really big day, but now they've just been up and down every day since. And a lot of that's because Trump has been, issuing all sorts of curveballs, a lot of it around tariffs. Um, so I guess where I'm going with this is the folks that were saying, hey, this is getting oversold, there's a tradable bounce here. Are we going to get that, or are we just going to get this kind of crazy whipsaw?
Adam, to answer that question, the market has been really indecisive. And honestly, the market's been in correction mode here for a few months. At the end of last year, it went sideways for a couple of months. It looked like it was going to break down, then it looked like it was going to break up. But then in the last couple of months, we've started a decided downturn. And I'm going to share the chart that we so often share here on this program. This is a chart of the S&P 500. And here's a daily chart. So the market topped back on February 19th, and it's been on this downtrend ever since. Now this is a pretty relentless downtrend the last the last month and a half. We went through the 50-day moving average, which is the red line, and then the 200-day moving average, which is this green line we went through. And a couple weeks ago, I mean, that was just down every single day, and the market was having trouble finding a bottom. And now we get this, what so far looks like an oversold bounce. We just don't know. Here's the thing. We came back and we have now gone above the 200-day moving average. And then we came and here we are right now today sitting exactly on the 200-day exponential moving average. It's an important line. Some other lines on the chart we've got hedges down here at 5,400 just in case we crash right from here. We want to have some insurance in place on a good part of our stocks, even though we don't have very many stocks. And then the 50-day moving average above here, it would be the next target. So, I would say that the market is trying to decide. It's keeping investors on their toes. We had a nice big day. I guess it was Monday. Then we went sideways Tuesday, and then we had a big down day yesterday. So a lot of growth stocks got hammered yesterday. And, the interesting thing though, if I were to zoom in here just a little bit, you can see this gap that was created on Monday. That's could very well be a breakaway gap. And this Monday could be, a confirmation of a new trend. However, we don't know. This move yesterday has got a lot of people concerned. I can say that this move over the last week and a half has started to flip most of our indicators positive, but nothing is really that screaming loud, hey, jump on this bandwagon yet. I would say if we got a move up here to the 50-day and close above it, that's probably going to be a more all clear signals. But we have to go above 5,800 for that to happen. Right now, all we did is we came back and closed that gap. The NASDAQ did the exact same thing, came back and closed that gap. But it's a little bit treacherous because the NASDAQ's below the 200, the S&P isn't. The S&P is right on it. If we were to come down and take out these recent lows, and it would only take 1 or 2 bad days to do it, then everyone's going to be running for the exits. So we're watching closely. We're considering adding more exposure, but only if we get a continued or a confirmed move above this recent swing high and we come and challenge the 50-day. So it's a time to be cautious, and it's a short term. It's a time of great indecision. I will say that we saw a lot of negativity very quickly in the last downturn, and some of the polls, like the AAII polls, came in very bearish very quickly. So it's been a very quick negative reaction to what has been so far a relatively muted pullback. Around 10% on the S&P is where we reached on the maximum.
Okay. Let me ask you this, Mike. Let me ask two things. One, from a technical standpoint, I think I've talked to enough of you guys to understand that the importance of these sort of support levels. And so, as you said, we dropped below the 200-day moving average on the S&P. We then rose above it. And so the big question is, okay, does that level, which was once a floor, does that now become resistance, right? And we dropped below it, but then we went above it. And what I've heard people say is what you want to see from a bullish standpoint is a drop back to the 200-day, see it act as a floor, and then have, the S&P bounce off of that, and that gives, a stronger sense that, okay, there's now real upward momentum here. Did I describe that correctly?
Yeah, and I could reshare the chart if you want, Adam. So we had, like I said, that sell-off a couple weeks ago. And VIX got up at 30 plus, I think. And then we have a bottoming attempt in place right now. And then the market on Monday had this breakaway gap, this big gap and a huge up day, 100 points. That brought us above the 200 day. And now is the test. Right now, I'm looking at the chart that I just shared. We're right back to that 200 day. So I think that what you're describing is exactly where we are right now. We're back and testing that level. What
Right.
we don't know is what's going
We're
to
at the
happen
moment of
next.
truth, right?
Yeah.
Does it break below and then we say, hey, this was a failed rally, and then look out below, or hey, 200-day has regained its status as the floor, and then things are going to bounce higher. Yeah, so we'll watch this quickly, and hopefully when we talk about this in a week from now, we'll have more clarity on this. Reason why I asked that technical question is I know you and John have said, valuations matter in the long run, but in the short term, they don't. They don't have a lot of price prediction. So that's when you sort of rely much more on market technicals. And so my question
Yep.
for you guys is, what's it like? Or let me put it this way: can we rely on market technicals as much in a highly changing environment like we're in right now, where there is non-market forces that are surprising Wall Street on a daily basis, right? So yes, the market's going to do what it's going to do technically based on, kind of the principles and math of technical analysis, but you have these new vectors coming in that the market can't anticipate, like, oh my God, Trump just announced a whole bunch more tariffs than we were expecting, or man, he just called them off, right? So how useful is technical analysis in this highly uncertain world where you have these non-market distortions going on at such a rapid frequency?
I'd say moderately useful, Adam. We talk about things like the 200-day moving average. Remember that everything that you do with technical analysis should be done with a very, very wide margin. Use a fat pencil. I often heard somebody say that I respect in this business. I mean, the 200-day exponential moving average is not the end all be all. We go down below it, we go above it. Really, it's a culmination of trend. The short-term trend of this market is down, but the longer midterm trend is up, solidly up. And I don't think it's really broken until we go quite a bit lower. So the longer term trend is up, and it's really undecided as to whether that longer and midterm trend is changing. And we're testing that theory right now. But yeah, the whole world's looking at things like the 50-day and the 200-day, and they matter only to the extent that if we get a reversal from these levels, then it'll be an excuse for the market to run. Then market participants will jump in and they'll say, well, we bounced off the 200, but it wasn't really the 200 itself. It was the fact that we're still in a mid to longer term uptrend. And this is just a potentially a test of that uptrend versus a more durable change. So technicals come into our decisions, but they're only part of it. Valuation, sentiment, macro, theses, all kinds of things come into play. Um, but shorter term technicals do matter, particularly in this bull market. Most of these technicals worked on the long side and didn't work on the short side. So, and I suppose that's because the trend has been so relentlessly up on the intermediate to long term. So, remember your time frame, remember what the bigger or the larger time frame trend is, and give it some respect until it's got some real reason to not be respected. And so far, trading just where we are here, it's just a test so far. And when it's not like we're super bullish, we think this market's going to drop and drop hard. We think the market's going to lose more than 50%. So why are we even bothering talking about bullish signals? Well, it's just because it's possible. In fact, it's likely that this isn't quite done yet.
Right.
So
Well, you
we're
got to
on
trade the
alert for
market
it.
you have. Yeah. Exactly. All right. All right. Well, thanks. John, I'm going to come over to you. And Mike, I normally talk to you, let you take the baton when we talk about gold. I'm going to let John take it this week um, because he's got some charts, I think, that are relevant to the fact that gold is trading at a new all-time high at the moment we're talking here. Um, John, real quick, before you bring up those gold charts, anything else to add on top of this whole topic of volatility and my question about sort of these non-market vectors and how they might, I'm guessing, make your job even more difficult than normal?
Yeah, certainly the headlines affect psychology, and that's what markets like we're in right now certainly are being driven by. Um, Regarding technical analysis, it's funny because there's a saying that a lot of these things become self-fulfilling prophecies. Simple things like moving averages become like these beacons that people, turn to as like ironclad kind of things, and it's not quite that simple. So let me just give you a glimpse as to what I mean there. So if I look at, and we look well beyond technicals, well beyond just simple moving averages. But if I look, for example, here's just a filter on some of our technical dashboard, and we look at the percentage of stocks. So, for example, here's the different indices, and let's just focus on the 40-week moving average. That's 200 days. 40 times 5 trading days per week is a 200-day. You can see, so yeah, we're right at the 200-day moving average, as Mike talked about on the S&P. But there's not even 50% of the stocks in the index itself that are above their 200-day. So there's context that matters here. Being above the 200-day and having a large percentage of the index also being above the 200-day is a much more forceful statement than the index peaking above it, but a relatively low percentage of stocks actually themselves being above their 200 days. It's what we call breadth, right? So you have to look at a patchwork of different kinds of technical indicators to get a more robust weight of the evidence kind of signal. That's how we operate. We never take one simple technical indicator as a light switch kind of indicator. It's the concert and the unison of several indicators that we look at to help hopefully make a more robust signal. So just want to add to that context. But yeah, Mike covered all the bases there, I think, pretty well.
All right, good. Well, here, so let's get into gold now then. So, as I mentioned, it's hit a new all-time high. It had a great run that we've been tracking. You guys have done a great job of tracking for us weekly going forward, weekly up to now. Going forward, I think there's a lot of question about, well, is it overbought? Does it run too much? Should we be expecting a pullback, whatnot? I think a lot of folks were thinking once we touched 3,000, there was going to be some big cooling off period, but not really so far. So gold's now closer to 3,100 than it was to 3,000. Where do you think all this is going? And as I mentioned, I know you got some charts you wanted to show us.
Yeah. So gold and gold miners have been tremendously strong. And as you and your viewers will know, and our clients certainly know, we've been bullish on gold and miners, especially for quite some time. And frankly, we fought some negative trends there for a while. But our conviction was pretty strong, and the technicals and the trends have been very, very strong. We just today reached a new all-time high, as I think you mentioned in bullion itself. We'll talk a little bit about the miners in a moment because they've been on a relative basis much stronger, frankly, in the last couple months. But this idea that, hey, we've reached an all-time high, geez, we must be ready for a pullback. There's always the probability of coolings off or pullbacks. But much like stock market bulls will oftentimes make the case when new all-times in the stock market are made, that they oftentimes are made repeatedly in quick succession, yet another new all-time high in quick succession. Well, the same actually can be said about the gold market. And I'm going to pull up a chart here, a great chart that Warren Pies from 314 Research pulled together. And this pretty much in a picture says it all. So these red lines are basically clusterings of all-time highs of gold. So you can see we've been in a cluster in the last several months where repeated new all-time highs have occurred, and there have been times in history where that has happened. Of course, eventually all markets change trend and pull back. It doesn't need to mean a crash, but it's natural for markets to exhale and regroup because there can be short-term times of of exuberance. We don't think we're there in the gold market yet. But who knows? Probably will be a time where where it does deserve to take some chips off the table or hedge or get more defensive. But let's look. We talked a couple weeks ago, Adam, on our video with you about the GDP now estimate that's put out by the Atlanta Fed, and many people were making huge waves that the GDP readings fell way off a cliff. They went from positive over 2% to almost negative 3%, almost with the flick of a switch. Now, of course, I need to make viewers aware this is what's called a nowcast. It's not meant to be a forecast. It's a continually updating data series that as new data comes into the fold, the Fed updates it. But the noteworthy thing here, as it relates to gold, is that I made the point in the video with you last time that much of this huge decline in GDP on this nowcast was really associated with a massive amount of importation of gold into the country. Because from a GDP standpoint, imports detract from GDP. It's just the way the math works. So the Fed felt so compelled to clarify this that they've actually, in their latest chart, they show a gold adjusted reading on this data metric. You can see it goes from negative 1.8 to about 0.2. That's a huge difference simply related to the massive amount of importing of gold that's happened over the last several weeks and months. And that's kind of eye-popping in and of itself. But maybe what's even more eye-popping or brain-popping is in a $27 trillion GDP economy, the fact that who the heck's importing so much gold and why, and to have that much of an impact on such a huge economy speaks tremendously loud volume, I think, and it just speaks to some of the buying central banks and otherwise that have been really behind this strength in gold.
Absolutely. So, a couple of things. One, we've had some folks on the channel, Andy Scheckman being a real notable one, talking about, the volume of gold that we're seeing flow to the U.S., especially from the LBMA vaults there in London. And he's been saying if you look at the volume of it and you look at the amount of bullion that's futures contracts that are being opted to be taken once they expire to have be taken in delivery, right, of actual metals. He's basically saying, look, I mean, the size of them, it's hard to see it as anything else than some sort of sovereign buyer, right? Some like really deep-pocketed sovereign buyer. Some of the more recent speculation I've seen has been, probably maybe the U.S. government even, right? Now, we don't know. This is totally all speculation here, but as you said, it's big enough to move the needle pretty dramatically on the largest economy in the world. And the fact that the Atlanta Fed actually called out kind of a gold-adjusted correction, to its GDP now, I've never seen them do that before. I mean, not with anything, right? And the fact that they're doing it with gold, one speaks to the magnitude of what's going on, but also too, like, gold is this thing that the establishment has done its absolute best to ignore, to pretend doesn't exist, right? And it's only very recently that we're starting to see this sort of acknowledgement that gold is important, right? And so this is definitely a big sign here with the Atlanta Fed showing it, but also just the talks recently with the new administration about sovereign wealth fund. What do we put in there? Should we audit Fort Knox? Should we think about revaluing gold, et cetera, et cetera? Now, I heard Bessent talk recently, and he said they're not going to revalue gold. Maybe that'll change next week. Who knows? But the fact that it's actually really being talked about as a valued asset that has the ability to, as you say, move the needle on a 27 trillion economy. It shows to me that the West is finally really beginning to wake up to gold and gold's importance. And we've talked about how, first, as Grant Williams famously said a decade ago, nobody cared about gold except for the gold bugs that had their thesis, but it didn't matter because nobody cared. Then the central banks really started buying. Then the Eastern investors started to buy, but the West hadn't woken up. Now maybe the West is finally beginning to wake up. And this is right as gold crosses 3,000 an ounce. If Western demand is just beginning to wake up here, you wonder what kind of tailwind that might put behind gold. So even though people are saying, gold's played out, it's hit 3,000 an ounce. Sure, there could be some cooling off period in the near term, but this could maybe be the shoe to drop that a lot of gold bugs have been waiting for. I don't want to oversell the moment, but anyways, I just wanted
Yeah,
to
I
note.
wanted, Adam, I'd be remiss if we didn't talk about gold miners. I did allude to the fact that after many months and years even of the miners lagging the metal pretty substantially, we've seen a complete, recent, but a complete reversal in that. The miners have been quite a bit more robustly strong than the metals itself. And I'll just quickly share a chart of GDX, which is a very
Yeah,
popular.
bring up the chart if you can, because that is a new and I'm sure to many people welcome development.
So this is a chart of GDX. You can see right here is the change of the year. This is January 1st here. I think we're up at 30% on this basket of miners year to date. Been a very, very strong basket. You know, we had a little bit of a pull, breakout from this prior high here. The end of last year was a painful kind of testing of people's will, because miners, after having a pretty strong year, sold off pretty dramatically into the end of the year. Maybe it was profit taking, booking some unrealized losses. Who knows? But it's been out of the gates very strong year to date. We had a brief pullback here, and we're up strong again today. So very the way we think about miners, certainly relative to bullion, is on things like relative strength. So this is a relative strength chart of GDX, again a popular gold mining ETF, against GLD, the largest gold bullion ETF. And quite simply, this is what's called a point and figure relative strength chart. Anytime we're in a column of X's, it's basically suggesting or showing that the price movements have been more dramatically to the upside than to the downside, or relative to bullion. So clearly, for most of this year, the miners have been on a relative strength signal in a positive way relative to the bullion. So in fact, we have about 10% in precious metals right now. That's up from about 5% we have it all in the miners. We were previously about 5% in miners, and then inched up to 7.5%. Now we've built it to the full 10%. The balance we previously held in bullion, because we were waiting for that relative strength signal change. So it's been a very helpful component to our portfolio positioning. Our clients have, I think, ridden out, and certainly some of the compliments we're getting, people are resting pretty easily, I think, despite the volatility and the headlines in the market.
All right, but on that point, John, so I mean, for a good long while, a couple of years at least, the miners had really underperformed the metal, certainly on gold's big move since the CPI, initially started spiking to 9% and coming down. So is this something that you expect to kind of pick up steam from here, meaning that even if gold starts to level out a bit, that the miners may still really catch their bid now?
Yeah, we think they're still fundamentally undervalued, but we've thought that for many years now, frankly. And just like an overvalued stock market doesn't mean it comes down right away, so too with undervalued securities. They can stay undervalued and get much more so, despite that undervaluation. But the combination of the powerful relative strength and what we still measure to be a very value type play here relative to the free cash flow and the fundamentals of the sector, we do think, at least based on data right now, the miners will continue to have the upper hand. But we don't have to predict that. We can watch and observe how things unfold here and take defensive or tactical measures as that unfolds.
Okay. And I just want to remind folks, if you have not been very invested in the precious metals, but are thinking about it, but still, would like to understand better what the different option sets are and when it makes sense to actually own real physical bullion, or perhaps, buy some of these ETFs, or start, perhaps taking an investment position in the miners, et cetera. I released a few weeks ago the new buying guide for how to buy and store gold and silver. If you haven't read that yet, you can read it for free over at thoughtfulmoney.com/gold. All right, gents, we got to wrap up here. But let's, if we can, we've definitely seen a lot of debate in the media about whether we're going into a recession or not. And again, somewhat ironic, because about middle of last year, media just decided, just bought whole hog into the no landing scenario. But now that we've got the new administration worrying a lot of people, all of a sudden there's a lot of concern about recession. Certainly Steve thinks that odds are pretty good that we might enter one this year. I mentioned talking to Steve. I've got that new free guide out as well about helping people, potentially prepare for layoffs or at least reduce the risk of getting laid off, or if they get laid off, what are the immediate steps they should be doing. You guys talk to investors of all stripes every day, your existing clients, people that are, interested in talking to you, maybe potentially being clients, but more just taking you up on those free consultations we talk about. What's the tenor that you're getting right now from sort of the general investor about, this heightened uncertainty, both in the markets, but also maybe a little bit more existential, like, and hey, I might lose my main source of income here. John, why don't we stick with you real quick and then go to you, Mike? So both the tenor you're hearing and kind of what's your general advice to these folks?
Yeah. So, I mean, we're not seeing a dramatic amount of panic in our clients at all, across, a broad swath. And partly we think it's because we've been prepared for this kind of volatility. We've been very defensive and conservative and hedged. So, in some ways we've been prepared for this kind of episode. But on the edges, we are seeing some increasing concern. Some people worried about their jobs, others, kind of taking a step back and saying, you know what? My biggest concern right now is not, catching the late stages of a very overvalued market. I'm in a good spot. I think I'll be okay financially, so long as I don't lose a lot. So that we're starting to see some of that subtle mind shift come into play. So for example, just a handful of our clients have asked selectively to be somewhat even less invested in equities than we already are. I mean, we're only about 40% in equities right now, hedge. So our exposure is very underweight. But for some clients, they actually have asked to become even more so, and that's fine given where their specific situations are. So it's not a rampant, uh, broad swath of our conversations, but around the edges, we're starting to see some of that stuff creep in here, which is they're healthy conversations to have. Folks should be thinking about their overall risk exposure.
All right. And then Mike, I'll let you have a last word on this, and then we'll wrap it up.
Yeah, people are by and large worried. This little pullback in the market, even though there hasn't really been much of a down move in the accounts of our clients, has people very worried. And like John just said, a number of people have asked us to go even lighter in exposure than our already conservative stance. I would say that 9 out of 10 people we've talked to in the last month have asked us to go even more conservative than our already conservative stance, and maybe 1 out of 10 wanted more. So that's a pretty heavy. Most people are on one side of the boat there. Now, that doesn't necessarily portend a bounce higher, but surprising we're seeing that amount of concern that quickly, based on what's happening in the market. But I think it's probably more than just the market. It's probably, the where we are in this cycle. It's probably the fact that we've got a new president, and the fact that we're talking about tariffs and threatening of tariffs and that kind of thing. So people are feeling really uneasy, and they want to talk about that. They want to talk about, what can they do, how to protect themselves. There's a lot of questions about gold and silver, because even though we've been talking about that for a long time, we're breaking out to new highs, and they're thinking that maybe it's a way to protect themselves. So yeah, a lot of worry, Adam, and I would say that's really the tone of the last few weeks. And we're here to help people be less worried. There's not a lot of reason to panic or be overly worried. Just take care of the basic things and make sure you got the hatches battened down, and we'll all be fine. That's our message. But happy to talk to anybody.
All right. And that totally comports with what Steve said. Folks, practice the 5 Ps, be thoughtful, take proactive action when the sun is still shining. So if you are, feeling maybe a little bit of anxiety about where things might be headed, either with your financial portfolio or with your job or whatever, to all these different people's counsel, do something about it now. And that might be just as simple as, reaching out to your existing financial advisor, or if you don't have one, perhaps talking to these guys here at New Harbor or one of the other endorsed financial advisory firms by Thoughtful Money. Just have a conversation. Like there's no downside to just saying, hey, war game this with me. If this were to happen, how well am I positioned? If this were to happen, how well am I positioned? What changes might I want to make today to make myself a little bit more financially resilient in the future, given what might be happening? So highly recommend you do that. And obviously, if you want to talk to one of the folks here, perhaps even John and Mike there at New Harbor, just go fill out the short form at thoughtfulmoney.com, and you'll be matched with one of our firms, and they'll reach out. And again, those free consultations are totally free, and there's no commitment to work with these guys. It's just a public service that they offer. And if you are worried, again, potentially about your vulnerability at work, if you want to get the free guide that I mentioned there about protecting against layoffs or what to do if you get hit with a surprise layoff, just go to thoughtfulmoney.com/layoffs. All right. Well, John and Mike, look, another great week. Thanks so much for doing what you do, keeping us abreast of what's going on, helping us, better understand what's happening in these highly volatile markets these days. And like you said, Mike, we're gonna know hopefully by next week whether or not this test that we're seeing right now holds or breaks. So, gentlemen, look forward to seeing you next week.
We look forward to it too, Adam. I think we're going to know a lot more, and we'll take a look at the charts and come up with a conclusion next week. Thanks for having us.
We'll see you next week, Adam. Thanks. Always fun to be on with you. Thanks.
All right, boys. Thanks so much. And everybody else, thanks so much for watching.